Friday, and as all Fridays, today as well, we have the ladies special on Your Stocks, where we answer queries coming in from all our female investors, viewers, traders. Joining us today to answer all the queries of our females, we have Mayuresh Joshi as well as Prakash Gaba. Thanks a lot, gentlemen, for joining in and helping us out, or helping our viewers out too. With that, we move on to our first caller of the day. We have Soumya Dhanabal, who calls us from Coimbatore. Soumya, go ahead.
Hello, sir.
Hi, Soumya.
Sir, I have 200 shares of Union Bank. Can I add or hold it at the current level?
You bought it when, Soumya?
6 months before.
And you are okay to hold on for a longer period, or are you in the need for money?
I am holding for a longer period.
Mayuresh, what's your take on Union Bank? Is there cause enough to remain invested?
Good afternoon, Sumera. I think the results were quite reasonable this time around, but it was affected by tax credits. And yes, you did see a 17% NII growth. But the GNPAs, net NPAs still remain at elevated levels. So if you look at GNPAs at 15.7 odd percent, net NPAs at 8.7 odd percent, I think that does not add comfort. And though I think the management we put through, that recoveries and upgrades will probably be far better in the provisions obviously sequentially have gone down quite significantly, plus the shedding of their non-core assets to the tune of 360 odd crores should abet. But I think the treasury income has also got hit because of the impairments done in their investments. So in a nutshell, I think the loan growth should be quite tepid. What we're probably seeing in terms of stability that one needs to see on the asset quality probably needs to be monitored over the next 2 to 3 quarters. Recoveries, upgrades also need to. And at the same time, I think the earnings growth, because of all these issues, need to be monitored as well. So I think the same choice here would be that if you can sell the stock on rallies close to the price of acquisition, and probably look at the private banks, because we still remain extremely optimistic both in terms of advances growth for banks like an HDFC Bank, where obviously you've seen some amount of concerns because of a management resignation. But again, largely the CASA book is holding up and the retail advances are holding up pretty strongly as well. NIM should bounce back, so I think HDFC Bank becomes one of the choices. ICICI Bank as well, I think yes, it's gone through a torrid time in terms of what's happening with the Chanda Kochhar probe. But a large element in terms of what the dynamics of the bank should exhibit going forward, with retail advances at 58 odd percent, the cost to income ratio expected to come down, asset quality expected to remain stable, should lend support to ROAs improving to 1.2, ROEs improving to 11 odd percent, and very, very attractive even on the price to book parameter. So I think sell the stock on rallies close to the market price and probably look at these two stocks on dividends.
All right.
To another one, we have Navya Jumnani. She writes to us from Bengaluru, holds 500 shares of Tata Steel at 610 rupees for the last 7 years. She is a long-term investor, wants to know whether to hold or sell. Well, she bought it at 610 7 years ago. It was the cyclical nature of the sector that 6 years hence it has just made her 6 rupees per share. Mayuresh, what would you suggest? Tata Motors, after 6 years she's got her price.
Steel.
Tata Steel, I'm so sorry. Tata Steel, after 7 years she's just got her price. What would you say?
So Mangalam, I think this is the irony of commodity stocks. I think you have to play the cycle perfectly well, and it's very difficult to probably gauge these cycle movements. Having said that, again, the kind of numbers posted both in terms of the domestic EBITDA per ton at 17,000 rupees and the expected production numbers to probably stabilize over the next 2 years between 12.5 to 13 MT. The expectations here are that even if it doesn't post an EBITDA per ton of 17,000, it normalizes to 14,500. I think it's still making a reasonable amount of leverage on its domestic operations. Couple that up with the capex that they've announced for the Kalinganagar expansion of 5 MT at 23,200 odd crores. That should also start giving them back-ended returns because the plant itself is 100% sourcing iron ore and 35% coking coal. So that probably protects their EBITDA margins. The international operations are pretty much held on as well. So if one really expects around 9 to 10 MT with an average EBITDA per ton of anywhere between $75 to $80 a ton. I think those operations might look reasonably stable as well. But the outside risk is what probably happens in terms of the tariff imposition and what kind of a repercussion would that have in terms of both LME realizations and the cost push actually moving higher. So large element in terms of an EBITDA valuation. I think the stock looks reasonably priced at this point of time. But again, I think the investor, if she has a long-term horizon, she can probably hold on, but she has to look out for these factors going forward, specifically I think on the international trade tariff front and what happens with the European operations. So hold at this point of time, but clear monitoring is required for this stock over the next few quarters.
Meenakshi Vashisht's query. She writes to us from New Delhi. She holds 100 shares of EIL at 156 rupees for the last 1 year and 5 months. Long-term investor wants to know whether to hold or sell. Mayuresh, your views on Engineers India?
So Mangalam, I think the problem that's plaguing is the execution on their turnkey projects, which account for 44% of the revenues, and obviously the turnkey projects EBITDA margins are far lesser than the consultancy revenues, which contribute 55% to the top line. Now the other interesting aspect here is that the management has actually guided for order flows of around 5 to 6,500 odd crores on the existing order book of around 7,200 odd crores that it is sitting at the end of last quarter. Again, I think the cash reserves are substantial, which means I think the company carries no debt on its books, but the cash reserves itself ensures very healthy dividend payouts. Now the order flows are expected to come through are from either the refiners expanding their capacities, or there is also the expectations of crude storage expected to come through. However, I think the street is worried in terms of the margin deterioration because of the turnkey projects, and the margin estimates can be anywhere between 19.5%. So how the management is able to successfully transition this in terms of executing more, having better asset turns, at the same time generating cash flows from their consultancy business and increasing the dividend yields, I think that aspect would be very, very interesting to note. However, valuation looking quite reasonable at this point of time. So if the investor has patience and a long-term view, I think she can continue holding on to the stock.
All right, remain invested in EIL and also watch for the market. It's at the high point of the day now, so 340 points added on the Sensex as we speak. Mrs. Nikita Guru Prasad has written to us from Pune. She has 500 shares of Granules India, which she bought at about 143 odd. She's been holding on for a year. Long-term investor, wants to know what she should do at this point. Mayuresh, you think it's good for more? Should she remain invested for the long haul?
I think so, Sumer. And again, I think they've got blockbuster molecules, so paracetamol, ibuprofen, and again, I think metamorphin. So I think these products contribute significantly in terms of their overall product suite. But what the company has probably done over the last few weeks and quarters is that the raw material costs, which have shot up significantly because of the increases in crude prices and the rupee depreciation, they're actually taken price hikes. So to a certain extent, that does compensate for the input cost inflation that we've seen, and that should abet their gross margins actually expanding. Now, what also the EBITDA margin performance that the company had reported at 16.5% for FY18, you should see gradual improvement because of these factors. The other element is also the kind of capex requirements that the company is expected to do. They're expecting around 50 to 55 odd crores to be spent on its oncology and the specialty block. At the same time, expecting 7 to 8 ANDA filings and 5 to 6 approvals coming through. So all in all, I think the earnings improvement should be better over the next few quarters, which should reflect in ROEs actually improving from 12% to 15% over the next couple of years. So yes, I think a clear hold from my side.
Mayuresh Prakash, thanks very much for joining in this afternoon and for advising our many viewers. We'll wrap up on this show. Remember to keep sending us your queries, email them to us, and we'll address them with our experts through the week. Do stay tuned. Closing bell will take you through the last hour of trade.